The Dutch ambassador to Ghana, Ron Stricker, is challenging government to do more in reducing its public spending in order to boost the country's revenues. He was speaking at the Championing for Change conference in Koforidua in the Eastern region. Here's more in this report.
The Netherlands government has been supporting efforts by Ghana to improve tax collection, mainly at the large taxpayers' office of the Ghana Revenue Authority, GRA. There are concerns government may miss its revenue target for the year, given the figures recorded so far this year. Mr. Stricker indicates that Ghana could take a cue from the Netherlands in improving the situation.
In fact, a country's ability to collect domestic taxes and spend those resources effectively lies at the crux of financing development. They believe that effective collection of revenue can strengthen the social contracts, here it comes again, between citizens, companies and government. Strengthening public investment, the management of public enterprises, good management of public enterprises, social transfer payments and procurement can build confidence in the efficiency of public sector expenditures. This is key to ensuring taxpayers' willingness to support taxation, effective taxation. I would add, from the Dutch perspective certainly, because we have seen now a number of very compelling arguments for good taxation and for having a good tax basis and for having a good tax collection, I would add that on a national scale, taxation, in particular progressive taxation, is a means to combat inequality in society.
Technical advisor to the Commissioner General of the Ghana Revenue Authority, Henry Yentumi, is however reaffirming the authority's commitment to implementing measures that would help increase revenue mobilization.
What we would like to assure Mr. Speaker and the Dutch government is that we would undertake to ensure integrity in the use of the resources that they've actually provided to the country. And that one of the key elements of our conversation will be around impact analysis. How does it show? How do we show that we are offering value for money? How do we ensure that we are making the impact in bridging the tax gap? And how do we ensure that we are providing sufficient funds for Ghana beyond aid? So it's something that is high on our list of agenda as well, and it's something that we'll be pursuing. Just touching very briefly on another point he made is the role of top management in change management. And thank you for making the point that this is probably one of the most important subjects for GRA at present, the idea of change.
We are moving on now to another story that is developing. The expected interest we paid on the energy sector bond has raised some questions about the impact on the cost of borrowing. This was after managers agreed to pay 19% as interest on the 7-year bond and 19.5% for the 10-year bond, which would now be closed this Friday. Georgia fears more on this and why managers could not raise the entire amount targeted.
Depending on whom you will engage in the financial space, the views might differ. Whilst some believe that the rate settled on may set a new benchmark rate for borrowing in the country, others disagree. For those who think that it would impact on the cost of credit, they argue that since government sponsored the ESLA PLC bond, interest being paid should be seen as just like any other government paper. So if you should go by the theory that you wouldn't get more better sovereign than your government, then what is being paid on the ESLA bond, which is about 150 basis points higher than the current interest on government's 7-year bond trading on the Ghana Stock Exchange, then that would definitely set a new benchmark. However, others believe that there is no way this rate would impact on the interest of cost of credit in the country. They argue that since the ESLA paper is not a government bond or a strictly corporate bond, there is no way this would impact on the cost of credit over a 7-year period or even 10-year. On the possible reasons for not getting the entire amount, some of the experts the Joy business have engaged were of the view that the price that was offered was not enough to compensate for the risk associated with the bond that was not fully backed by government. This is because the gap between a 7-year bond and the 10-year bond was just about 0.5%, which some say was not enough. Again, the difference between the 17.5% on the current government yield and this bond showed that investors were asking for more compensation. Managers of the offer, Standard Chartered Bank and Fidelity Bank, last Friday managed to raise all the amount targeted in the 7-year bond, but had some challenges in getting all the 3.6 billion cedis targeted 10-year bond, resulting in an extension to this Friday.
In a related development, managers of the offer have justified interest we paid on the energy bond. They have also downplayed reports that the results demonstrate declining investor interest in the country's bonds. There's more in this next report.
The responses were contained in a set of questions and answers sent by managers following enquiries from journalists on the bond results. According to them, the interest expected to be paid on the bond was based on a lot of considerations by sponsor of the bond, that's the Ministry of Finance. This follows reports they could not raise the entire amount because investors were asking for 20% as payable interest on the 10-year bond. But the arrangers of the bond argued the approach to the pricing was reasonable, maintaining that it was important not to overpay. But they were hopeful the yield would reduce over time. On reports that the 10-year bond was not successful because most investors were not comfortable with the security of the ESLA levy being used to settle the bond, Standard Chartered Bank and Fidelity Bank maintained that investors have been adequately protected. They also rejected claims that the results demonstrate declining investor interest in the country's bonds, arguing that the expected interest was not gotten because this is a new type of assets being issued by Ghana. However, most offshore investors only have the mandate to invest in bonds that are guaranteed by government. But they were hopeful that as the bonds perform over time, the required interest would be secured.
We'll stay on this issue a little while longer because the Chamber of Petroleum Consumers Ghana, COPEC, GH, is calling for an immediate halt, revision or discontinuation of the energy bond, saying it will only prolong the cost burden on the innocent consumer by adding almost $500 million to the existing debt portfolios. COPEC is additionally urging strict application of the proceeds of the Energy Sector Levies Act, ESLA, to ensure that the agreed payments schedules are not missed. Failure to do these, among others, will only lead to filling a leaking basket, which will never realize the needed outcome. It says we have the Executive Secretary of COPEC on the line, that's Duncan Amwa, to explain further. Help us with your position on this matter.
What we are basically trying to avert the mind of government to is to the extent that the consumer of petroleum burdened. There is clearly the need to equally offset the energy debt. We should, however, not treat it as though it's a commercial loan we are taking from the open market, for which we think the coupon rate of 19.5%, which in real, monetary terms, that's some $500 million US additional debt to all of us to say. We think that is quite on the high side. There should be some negotiation with the banks who are owed these energy debts, and where necessary, if the government of Ghana would need to reconcile these banks, as happened in the case of our Western friends when there was a global meltdown or a crunch, the government has the power to help reconcile without necessarily selling a public debt as the energy debt in bonds, which will now attract close to 20% bond rate. That clearly would add further to the already existing debt that we are struggling to pay off.
So my understanding, you're questioning government's move to go ahead with the energy bond sale, right?
We think that following from the difficulty with raising the bond itself, it gives an indication that investors do have a challenge with accepting to use taxes, expected taxes as a basis to now invest their money for a 10-year period, knowing very well that taxes can be scrapped by another regime or same government as and when hurricanes even set in and fuel prices seem pretty wobbly. We believe that there could be a much better way to ring-fence the debt, the energy sector debt, such that the banks now who are owed these monies would not treat these monies as though they are commercial loans, but they are debts that the people of Ghana are struggling to pay. Going on the open market to take bonds at a coupon rate of 19.5% or additional 500 million USD value would only add further to the debt, and we think that something much more sustainable would need to be done around this time. We need to review the debt completely.
Okay, so yes, I understand what is taking place. Government, of course, is expecting some amount from ESLA over the 10-year period, and they're saying that, well, while we wait for that money, why not raise money from this bond and pay off the debt, and so that we can deal with other matters? Well, things didn't go well, and they have until Friday to raise the amount, and we're going a little ahead of ourselves to say, just stop this.
What we are saying is that the government still has enough time to call off the bond issuance. Clearly, we do not see how it would still meet the target, even though, admittedly, the original intention of ESLA was to be able to take care of some of these debts in a 5-year period, such that the taxi trotro driver will contribute something for a 5-year period to be able to pay for the debt in the energy sector, i.e. the power and petroleum sector. Thankfully, the debt that used to exist in the petroleum sector has been duly taken care of by the introduction of petroleum liberalization program. So today, you wouldn't have any outstanding, new debt arising from the petroleum downstream. What we now have continues to be power debt, right? And what is happening is, even as we speak today, some of these energy companies are still making losses and recording these debts in significant amounts. What we are suggesting is that the government should find an ingenious way to curtail these losses that ECG and the other power, continue to make. As best as possible, government should ring-fence the debt so that the banks, although are owed by both BDCs and the power players, the banks could understand that within a 5-year period, taking 41 pesos per litre on ESLA for Ghana, 10.2 million litres daily consumption, we should be able to offset this in 5 years. Going for a bond for 10 years means that the consumer is now going to have to continue paying the taxes that we are already crying against for some additional 5 years. And so the tenor now comes into question as well. How long consumers could have to pay these taxes also comes into play here. And
just a quick one, and I'd appreciate if you would be very brief on this matter. I mean, this continuation halting doesn't look like government would do that. They are way in deep, and so maybe a revision. What are the alternatives you'd suggest? Just a quick one. I don't think that we have Duncan Amma on the line. Yes, so we'll move on to other stories. Tonight, government is to develop a petroleum infrastructure master plan to serve as guidelines for the location of strategic petroleum infrastructure in the downstream sector of the industry. Over the next 3 years, the master plan will facilitate massive deployment of petroleum infrastructure as government tries to develop the downstream petroleum industry over the next 3 years. Deputy Minister of Energy, Dr. Mohammed Amin Adam, says the petroleum master plan would go before cabinet for approval before the end of the year.
We're developing a petroleum infrastructure master plan because you know that if we have to develop the downstream petroleum industry, it requires, significant amount of infrastructure. Infrastructure ranging from jetties, ports, petroleum depots, as well as other storage facilities that we need to put in place, refineries. And, if you don't have a plan, a master plan that details out or that guides you how you deploy this infrastructure, where you deploy them, which partners do you need to work with to be able to develop this infrastructure, then you are going to have a petroleum industry that is hollow. It's hollow because it is not built on any sound footing. Infrastructure is the basis of every petroleum sector development. And government is, determined to ensure that we roll out the necessary, infrastructure that will facilitate the business and that will facilitate the growth of the industry. And that will ensure that the petroleum sector becomes the instrument of transforming our economy and the lives of our people. And so we are determined that by the end of this year, we will have this important document before Cabinet. And once it is approved, Ghanaians will see over the next 3 years the massive deployment of petroleum infrastructure. I've mentioned jetties, I've mentioned ports, I've mentioned depots and other storage facilities, pipelines, and also refineries. And this is why we think that we could not just have allowed people to come doing things the way they want without a plan to guide the development and the deployment of this infrastructure.
In other news tonight, the Food and Drugs Authority is blaming the media for condoning activities of alcoholic beverage and aphrodisiac dealers claiming to have permission to advertise their products. Head of Communication for the FDA, James Latte, is worried about this trend.
Media stations are supposed to play adverts that are approved by FDA. When anybody walks to your station, you are supposed to check whether it has an approval from FDA for the advert before you play it. And I'm saying that if you hear any media station playing an advertisement of an alcoholic beverage as a medicine, having medicinal claim, it means that that media station is flouting.
Meanwhile, the Food and Drugs Authority says it cannot guarantee the safety of persons who are ignorant of their regulations. Head of Communications, Mr. Latte, says granted that the authority is responsible for regulations, individuals must also be interested in their own health. So far, 100 national service personnel have been trained to monitor markets ahead of the festive season.
And you talk about people that cannot read. It's unfortunate the regulator cannot station its officers in shops that uneducated people, things should be explained to them. No, that is why you have sellers there that are supposed to assist to explain to the people. And I always advise that if you cannot read, at least you have a grandchild or someone that can read, let them assist you. That's always what the advice I give. Because there's nothing much that a regulator can do when it comes to such people.
You're watching Business Live. We are taking a short break. We're back with an update on the stock market. That's after this break. Welcome back to the program. Time to do an update of how your stocks are faring or are expected to fare this week. Joining me is Bertha Atubiga. She's got advice on where to invest your money if you are an investor. And interesting, we're talking about the energy bond sale and the fact that investors are not expressing so much interest in it. At this point, what would be your advice to any investor out there?
Okay, thank you very much. Let me say that we're actually looking at a 5-year and a 10-year period. And if you look at the Ghanaian investment sector or what usually happens, most investors mostly look out for shorter durations as compared to these long durations that we have. And the longer duration is probably could be looking at the equity market, where you can actually come out at the time that you want, that if we have shares somebody available to buy your shares of. But the interest, I'm not surprised though, because most investors don't like long-term investment. This is actually a risk-free investment instrument because it's coming from the government. People that have less risks want to invest for this long period can actually take advantage of it. But if you're looking at getting maybe higher returns, you can also look at the equity market. But the energy bond it's good. The rates are relatively high as compared to what's happening now. And looking at the duration, it's a good bond. Just that the duration is what is actually deterring people away.
I guess we are getting some understanding as to why maybe some investors may be holding back.
I'm not surprised at all.
Pushing their monies into this. Right. So let's talk about this week's trading activities. Of course, the financials of some listed companies are trickling in. And so, I mean, how is all that working out on the stock market?
Well, this week, or let me start with last week, the stock market did very well. We had 10 movers. And we had, out of this 10, 8 were gainers, and we had only 2 equities losing on their previous share prices. We had only EGL and PBC. EGL lost a peswa to close at 3 cedis 96 pesos per share. But as of today, by close of today's trade, EGH, actually, EGL didn't move further. It's still at 3 cedis 96 pesos per share. And we had 2 equities move on their previous share prices, and EcoBank Ghana and then Total. EcoBank went up by 2 pesos to close today's trade at 7 cedis 60 pesos. And then we have Total adding 33 pesos in today's trade. After trading, we had 10 trades going on in Total and Cow. But Total, actually, we saw these trades pushing the share price of Total upwards by 33 pesos to close at 3 cedis 53 pesos per share. And if you look at the worth of these 2 equities on the market, there's a high possibility that we're going to see a marginal shift when it comes to the financial and the composite index by close of today. By close of today, we will see that upward movement again. On Friday, the major indices moved upwards, and today we're going to see that continue with the appreciation that we are seeing in these 2 equities. Aside these 2, we had trades going on in Société Générale. 500 shares go also traded 500 shares as well. I was going to ask about that
because earlier we got indication that the performance was expected to go up because they did well over the past 9 months according to their financials.
Yes, Société Générale has done very, very well. And usually what happens is when the financials are released, sometimes, it isn't always, sometimes the market actually responds to that. And the Ghana Stock Exchange, for some time now, we've seen that reflection of the financials actually having an impact on the share price movement. But it is not always, or it's not static that it should have that movement. Depending, all these factors actually goes into the demand and supply of the equity. If the demand is very high, considering the financials that have come out, then we could see the upward movement of the equity on the stock market, and that should tell. But today we had only 500 shares trading, and that was a single trade in Société Générale.
Great. We may have to move on to the currency because we don't have so much time. So how is the cedi performing?
Well, based on the Gold Coast Cedi Index, the cedi has lost 8.24% to major trading partners. And as a close of last week, the dollar recorded an average quote of 4 Ghana cedis 3750 pesos. The pound is 5 Ghana cedis 7358 pesos, and the euro is 5 Ghana cedis 0746 pesos. And if you look at last week, the cedi actually gained marginally to all these major trading currencies by close of week, and we're expecting it to exhibit some level of stability, as we've always seen on the market. And for some weeks now, we've seen the cedi actually gain to these major trading partners, and that is why we've seen the year-to-date returns, which actually measures the average performance of the cedi against these currencies on the interbank market, coming downwards.
Great to have you in studio as always. Thanks very much for the update. One more on to our interview of the day, still on the energy bond sale. And well, economist Professor Godfrey Bokpin tells Joy Business the country could have gotten a better rate if the bond was guaranteed by government.
Interview of the day.
Results
It's a true reflection of the risk inherent in the bond issue and then the overall government strategy to market the bond. And I think that the government's decision not to include the bond issue in the public debt and fully guaranteed by the government might have played a part in the results that we had, and especially with the longer dated maturity of the second one, which is the 10-year bond, that probably increases the risk of investors. If you look at our election cycle of just 8 years, and therefore there's greater risk with that one. Once the risk level is high, or once investors perceived the default to be very high, then they will see greater protection from the default risk. And if they are not getting the appropriate compensation for the level of risk that they will be assuming, then obviously they wouldn't want to commit to it the way that we were expecting. But in terms of the decision to issue the bond, I think that we all do agree that is the best way to go, because these arrears, especially from the state-owned enterprises, were actually sort of creating some systemic risk in the financial system, either directly through the balance sheet of banks in terms of the toxic asset created by these arrears, or the BDCs that invariably would also have some implication in the financial system. So the decision to issue the bond and resolve the energy sector indebtedness in the system is certainly something that we all do support. The strategy adopted probably does not reflect a view that I will probably subscribe to, and especially the idea of creating a special purpose vehicle or company to handle it, and government's own decision not to fully back that necessarily increases the risk. And once the risk is higher, investors will demand greater protection from the perceived default risk. And if they are not getting that, they won't commit to it. Of course, there are alternatives. But even if you look at the rate guaranteed for the 7-year, I mean, it's still quite high, but probably given the fundamentals of the economy, given the progress of the fiscal consolidation, and then other development in the economy, one would say that, well, we can accommodate that higher rate and bite the bullet and solve an issue that is creating some systemic risk in the financial system.
Interview of the day.
That's it for tonight. Thanks for watching Business Live. We are back same time tomorrow. My name is Darryl Kwao.